All right, let's jump right in. Today, we're looking at a market that is quite literally on a knife's edge. All eyes are on gold as it faces what might be its biggest test of the entire year. So let's get straight to it.
So what's the one number that everybody is watching? This one, $4,200. Now, you have to understand, this is way more than just a price on a screen. Think of it as a psychological battleground, a line in the sand where a massive tug-of-war is happening as we speak.
And this quote from our source material just nails it, doesn't it? Coiling like a pressurized spring. I mean, that's the perfect image. It tells you a huge move is coming, it's inevitable. The billion-dollar question, though, is which way does it break?
Okay, so how on earth did we get to this point? To really get why the market is basically frozen in place, we need to rewind a little bit and look at the incredible journey gold has been on this year.
Yeah, you heard that right. A staggering 60% rally. Just wild. But then, for the past few weeks, thud. It's like it just slammed into a brick wall, right at that $4,200 level. And this pause, this period of indecision, well, that's what everyone is calling the December dilemma.
So, what's actually causing this gridlock? Well, it's not just one thing. It's more like a three-way tug-of-war, a powerful collision between three totally distinct and competing forces.
So, you've got the Fed's huge decision coming up, you have a high-stakes geopolitical endgame playing out, and you have the shaky state of the global economy hanging over everything. Let's break down each one.
Okay, first up, the Federal Reserve. Right now, the market is almost certain we're talking a 90% chance of a rate cut. But here's the twist. Because of a recent government shutdown, the Fed is effectively flying blind. I mean, they're about to make this globally significant decision, and they don't have the latest inflation or jobs numbers to look at. This situation is so unusual, they're calling it the data blackout, and it just skyrockets the risk of them making a big policy mistake.
And this shows just how weird things have gotten. Okay, so normally when everyone thinks the Fed is going to cut rates, long-term government bond yields fall. Simple. But today, they're rising. It's the complete opposite of what should be happening. This paradox, it's called bear steepening, and it is a major warning sign. It's basically the market shouting that it's afraid the Fed is about to mess up and let inflation run wild. Think of it this way. If you were going to lend someone money for 10 years, and you thought that money would be worth a lot less when you got it back, well, you'd demand a higher interest rate, right? That is exactly what the bond market is doing right now.
Now, the second force at play is geopolitics. A big chunk of gold's high price is what's known as a war premium. But here's the thing, extremely high-stakes negotiations are happening right now. If they succeed and a peace deal is reached, that premium could just, poof, evaporate. But if those talks fall apart, it could trigger a massive flight to safety, sending gold absolutely soaring. And look, these aren't just some vague talks. There is a concrete 28-point plan on the table with the key proposals you see right here. So the outcome over the next 48 hours is a massive variable. But even while the market is watching that, it's also grappling with that third force we mentioned, the threat of Stagflation-Lite. Now, this is a really toxic economic cocktail. It's where you get slowing or stagnant growth combined with stubbornly high inflation. In that kind of scenario, traditional stocks and bonds tend to get crushed, and historically, it's one of the most powerful tailwinds for gold you can imagine.
All right, so we've covered the why. Those three fundamental forces all pulling gold in different directions. Now let's switch gears and turn to the charts to see if we can figure out the when and the where of this next big move.
Before we look at the numbers, just two super quick concepts to keep in mind. You've got support, which is like a price floor where buyers tend to step in, and then you have resistance, which is a ceiling where sellers usually take over. These levels basically define the entire battleground.
And this slide right here clearly defines that battlefield for us. The primary support, that buy zone, is sitting down at 4,050. The immediate resistance, that ceiling the price keeps hitting, is right around 4,250. And our current price? Well, it's stuck squarely in the middle of this technical no man's land.
But here's where it gets really interesting. Even within all this sideways, choppy price action, technical analysts have spotted a powerful and historically reliable pattern taking shape. It's called the bull flag. So what is a bull flag? It's pretty simple, really. Picture that sharp 60% rally as a tall flagpole. Now, this recent sideways trading period we're in, that forms a rectangular flag near the top of the pole. In technical analysis, this pattern is a classic. It's a sign that the market is just catching its breath, just taking a pause before potentially launching another explosive move higher. And this
This is the punchline. If gold breaks out of this bull flag pattern to the upside, the measured move, that's the technical projection based on the size of that first flagpole, well, it points to a price target above $5,000.
So we have the fundamental push and pull, and we have a technical pattern that looks like it's coiled for a breakout. Let's try to synthesize all of this now and see what the expert forecasts are saying.
In the immediate short term, the consensus is definitely cautious. It's a wait-and-see approach, with everyone waiting for the outcome of the Fed meeting and those peace talks. The general idea is to buy the rumor of a rate cut, but be really wary of a sell-the-news event right after.
But as soon as you look past the immediate noise, out to the first quarter of next year, the sentiment turns decisively bullish. You have major banks, like Morgan Stanley, raising their forecasts, and they're citing a huge structural shift in global demand.
And then there's the long term. By the end of 2026, the institutional view isn't just bullish, it's overwhelmingly so. I mean, a Goldman Sachs survey revealed that 36% of their professional clients expect gold to trade above $5,000. A lot of people are starting to see this as the beginning of a brand new structural super cycle for gold.
So what's the takeaway strategy from all this, according to our source material? Well, it boils down to a clear four-step process they call strategic accumulation. Number 1, wait for the event-driven volatility instead of chasing the price right now. 2, identify that buy zone between 40.50 and 4100 as a potential high-value entry point. 3, use a confirmed daily close above 42.50 as your breakout signal. And 4, view gold not just as a quick trade, but as a necessary hedge against all this instability.
And this leaves us with a final thought. Gold is at a truly historic crossroads, wound tight by these immense economic and political forces. The data suggests the pressure is just building and building for a major release. So really, the ultimate question for the market isn't if gold will make its next big move, but when.